Hello, I'm Greg Hammer, and I'm going to spend a few minutes with you today talking about maximizing Social Security and minimizing taxes. Hammer Financial Group, we're located in Cherville, and in our office, we do something unique. We kind of brought everything under one roof. Aside from the wealth management, we do have a Medicare practice, a tax practice, and close relationships with attorneys and insurance professionals to kind of bring everything under one roof for the planning for our clients. So I want to share a little bit and talk about a concept today about optimizing your retirement income plan. But I do want to share or start with a question. If you were to ask how often your financial advisor, tax professional, attorney, and or insurance professional communicate amongst themselves on your behalf to coordinate your plan, would you say it's often, sometimes, or never? Generally, what we find in our industry, it's never. It's something that's generally reserved for the wealthy and typically not provided as a value for most people as they're going through their planning process. So we at Hammer Financial Group take a very holistic approach when it comes to our clients. What we find generally is most people work in silos. They have people that work in different areas of their life. They have people that will help them with their investments, their taxes, their insurance, estate planning, Social Security maximization, Medicare, but typically they don't have people. There's no conversation amongst those professionals to talk about potential gaps or conflicts based on decisions that are made in one area that could impact another. So that's some of the stuff I want to share with you a little bit today. And the easiest way to share that is to talk about, the real tax system, the system that we have today, and how things that you do daily when you're working on either your distribution plan or investing, how they can create events in other areas of your life. So I'm going to talk just briefly about a couple of different areas: required minimum distributions, capital gains, your Social Security benefits, in potential Roth conversions or IRA withdrawals that can impact how your lifetime taxes will occur, and what are some strategies that we can do to reduce those. So let me start off a little bit with RMDs. Most of you are probably familiar. Those are the required minimum distributions that you have to take. Once you reach your age of 73 currently, that will slowly graduate to age 75, depending on the year in which you were born. But essentially, it's a required distribution from any of your pre-tax assets that you accumulated over your lifetime, and it's based on the Uniform Life Table. So you essentially take the December 31st value from the previous year, and then there's a factor that you divide by based on your age, and that will tell you the minimum amount that you're going to be required to take out. So example, age 73, if you had $500,000 in a pre-tax IRA, 401k, 457, 403b, you would have to take out about $19,000. If you don't, then you're subject to a 25% penalty, as well as the taxes on the entire withdrawal amount. So very important that we take those out. But one of the things that we look at in planning, those required minimum distributions may impact your overall efficiency and taxes when you have to take those things out. So we'll talk a little bit more about that and give you an example in just a few minutes. But I also want to talk a little about how capital gains work. And this is talking about married filing joint. If you're a married couple and your income is less than 96,700, long-term capital gains are taxed from a federal standpoint at 0%. But what's unique about this current tax code is all the way up to 600,000, that tax implication would just be 15%. But let's talk a little bit about how capital gains actually occur, because most people are familiar with, I buy something and I don't have a capital gain until I sell it. But there are other things that could cause capital gains while you're investing in non-qualified accounts, things that are not tax deferred or sheltered, and things like a traditional IRA, 401k, Roth, and things of that nature. So mutual funds, as an example, are investment companies. And so if I have a mutual fund investment, they are constantly buying and selling investments based on your objective. that your risk appetite, and they're not going to be planning or making decisions based on potential tax implications. So if you have a non-qualified investment brokerage account, these are the things that you get the 1099s for in March that you're not aware of until those um, actual tax documents come out to you. So those are what we call phantom gains. You may have not done anything other than let those mutual funds sit all year, but because of the buying and selling inside them, that's a pass-through event to you, which will ultimately impact your tax return. Other things could be rebalancing triggers. So portfolios, just by the nature of how equities grow versus fixed income, they'll get out of balance with a particular risk appetite. So people often have rebalancing triggers that occur quarterly, semi-annually, or annually. So when these sales occur to rebalance the portfolio, those could create implications. Again, not triggered by you wanting to use the money or selling it to get money, but just things to maintain the proper allocation in your investment. The problem is these long-term capital gains can create ordinary income tax. While they're a preferential treatment, they can impact other areas of your tax return. And again, this is all going to make more sense as we get towards the end of the presentation here. But Social Security, the third thing that I wanted to touch base about is tax based on other income. So there's something they call provisional income. What provisional income is, it's a combination of the 50% of the amount of your Social Security benefit plus everything else that appears on your tax return. Ordinary income, whether it be pension, withdrawals from IRAs, 401ks, 457, so on, dividends and capital gains from non-qualified accounts, even non-taxable interest. In fact, the only thing that doesn't contribute to provisional income is a Roth IRA contribution, or I should say distribution. So when we look at this provisional income, once they have that total, it's put up against a couple of thresholds. They're different based on whether you're single or married, but if we look at a married filing joint, if that total exceeds $32,000, that will directly determine the amount of your Social Security that now becomes reportable as income. So anything over 32,000 would 50% of that number would represent the amount of your Social Security that now becomes taxable. If you exceed the second threshold, that now requires an additional 35% for a total of 85% of that number represents, again, the amount of your Social Security that becomes taxable. So let me put this in a little bit simpler terms. If we look at a couple of situations, let's say we wanted a $90,000 income, we were taught our entire lives, save in pre-tax assets to a later date when taxes are hopefully lower. Well, taxes don't get lower in retirement because tax brackets don't change. But if we look at the first scenario, hey, we collect Social Security early, we're getting $40,000, we're taking $50,000 out, that will give us our $90,000 of income. But the problem is the provisional income is $70,000. Half of the Social Security, which is 20, plus the 50 equals 70. So if we go up against those thresholds, like we talked about, we exceed that first threshold by $38,000. So half of that, or $19,000 of my $40,000 of Social Security, now becomes taxable. But you also exceed the second threshold by $26,000. So an additional 35%, or $9,100 of my $40,000 of Social Security now becomes reportable, for a total of $28,100, or about 70% of my Social Security. Now, this continues until you cap out at 85%, meaning in this scenario, if you took another $1,000 out from your IRA, well, then you would have to have another $850 of your Social Security become taxable on your tax return. So that can impact your taxes in a way, even though the capital gains is preferential treatment, as ordinary income tax. Second scenario, let's say, you looked at 70,000, you delayed your Social Security, 70,000 is now the benefit. Now you would only need a $20,000 IRA to equal that 90,000 of income objective. But this dramatically reduces the provisional income, brings it down from 70,000 to 55,000, meaning that only 15,350 of your roughly 70,000 of Social Security is reportable as taxable income. So what does all this mean? Basically, if we look at the impact on your income, we want to look at it from a tax impact. If we go and look at the first scenario, we have a net taxable income of roughly $45,000. In the second scenario, we have a net taxable income of only $3,000. And what that basically translates for you is a difference of about $400 a month in taxes. So we feel like this is important information for people to know. And so when we talk about planning, it's about understanding how to minimize and manage tax implications over your lifetime. The challenge is there's nothing intuitive about the IRS tax code. There's three types of tax rates. You have your effective rate, which is basically the total amount of taxes that you pay relative to your total income. Then you have the standard rate table. That's what is being illustrated currently on the screen. When you reach certain levels of income, there's different tax implications. You have a 10% tax implication after your standard deduction, then 12, then 22, then 24. When you hit one of these new brackets, it doesn't make every dollar retroactive. Just the dollars that are in that bracket become taxed at that level. What you see by the green arrows are potential tax opportunities, things that are not going to be evident by looking at a tax return. These are areas where if we're in these brackets, should we bump up to the next bracket to create opportunities? This is where we could potentially talk about Roth conversions. The value of Roth conversions today is you have a considerably high income, $400,000 a year, where you're still at 24% tax implication or less. And the value of that is to potentially help you avoid marginal costs, marginal tax rates, which is the third tax rate I want to talk about. Marginal rates are the total cost of a distribution. So if you look at this standard rate, it's basically not talking about a time when we have started Social Security. When you see the next overlay, you see this gray overlay. What they're talking about here, if I have, let's say, things like Social Security, capital gains, that I have from a brokerage account, the time that I'll start paying taxes moves up dramatically. So if I have income that would have normally been eliminated from a tax event by the standard deduction, it's now much earlier. Instead of being able to capitalize on the close to 30,000, it's now much sooner that I'm paying taxes. And so when I'm falling into that provisional schedule, it creates more tax implications on things like Social Security that previously were not taxed. But what is this cost here? This 49.95%, this 50%. Well, that is what we call a marginal cost, a marginal tax rate. Now, at this point in time, you see that you're hovering over what is essentially the 12% standard rate. So if you took a distribution at that point, you would expect to pay 12% taxes. But how did we get to the 50%? So if I took that $1,000 out, I would expect to pay the 120. But at that moment in time, that additional $1,000, going back to what we briefly touched on, would cause another $850 of my Social Security that was previously not taxed to become taxable. Now, it would still be at the 12% tax bracket, but that's an additional $102 of taxes. If I had long-term capital gains, that's where I'm breaking that threshold where those capital gains were previously taxed at a zero rate, would now be taxed at a 15% tax rate, creating an additional $277.50 of tax implications. So the tax burden, that marginal cost of that $1,000 withdrawal, was about $500 or 50%. We feel this is important to know, and we feel this is important to plan for, and we feel it's important to manage. And there's many, many tools to help control these things. Having a diversified portfolio has huge value, but more importantly, it's understanding when or how do I take these distributions and from where? And from where? And then the other part of it is, how can Roth conversions impact it? Because Roth distributions do not create things like provisional income tax implications. They are completely tax-free. So how do we properly blend these and consider which assets that we should utilize and where they should be held, are how we look to manage taxes over your lifetime. And that's the area that we work with clients at Hammer Financial Group. The biggest thing to remember is not all assets are created equal. Pre-tax assets are always going to be considered ordinary income, which create the highest tax implications when you take those distributions. Post-tax assets, properly managed, can be very, very effective tools for distributions, like when I want to buy a car, to avoid that 50% marginal tax implication. And then, of course, your tax advantage accounts, like Roth IRAs, create a huge amount of value. So when we look to create better opportunities for planning, we will look at things like Roth conversions and what we feel is one of the friendliest tax brackets that you'll probably experience for the rest of your retirement. So that is the things that we look at Hammer Financial Group, and we operate under what we call the bucket plan process. Very simple process, very effective process. What it essentially does is positions assets for a purpose. You have the now, soon, and later buckets. The now bucket simply identifies expenses that we're going to have in the next year, and things like our emergency fund, money that we like to have at arm's reach so that we can, have it there for our comfort level if something should arise. The soon bucket is where we're going to look to create an income to solve the gap between what we call promise-based income and your lifestyle need. Promise-based income like pensions or Social Security, and then what it is that I actually want to have to maintain my lifestyle through retirement. This money needs to be approached entirely different than the later bucket. The later bucket is going to be our growth-oriented bucket, money that we want to utilize to plan for inflationary costs and things like legacy planning, specifically towards planning for a surviving spouse, right? Because one of the questions that needs to be answered if you're married is, what's the plan when the first spouse passes away? Because income will go down and you pay taxes at a single rate, not a joint rate, which means taxes go up, and generally expenses are never going to decrease. So the soon bucket approach is about creating income to avoid things like sequence of returns risk, which is market volatility, and you don't want to take distributions that are needed from accounts when balances are down. So which assets go here are going to be based on the current tax implications, risk appetite, and the amount of need, where later buckets, we're going to create the proper time horizon to absorb that market volatility and provide better growth opportunities over our retirement picture and over our lifetimes. So again, at Hammer, we take a very holistic approach when it comes to planning for our clients, and this creates a much more efficient planning strategy and distribution plan and retirement plan for our clients. We're going to understand how decisions that we make on investments could impact taxes, could impact Social Security, could impact things like Medicare expenses with what we call IRMA costs, additional expenses for Part B and Part D if your income is too high. So working at things from this holistic approach instead of silos, we find creates a tremendous amount of value for our clients. So if you'd like to find out more, please go ahead and request a time to have a phone call with us. We can send out a copy of our book. Jason Smith, the author, is a business partner of mine. Book is told as a fable, but it talks about a couple moving into retirement and some of the things that you need to be aware of. So if you contact us and want to set up a complimentary call to discuss a little bit further about who we are, how our processes work, and the things that we do, that call would be available to you to sit with either myself or one of my other advisors, and we would be able to provide you with that bucket plan book. So please go ahead and contact us today and set up that introductory phone call if you want to take a look at how a holistic approach and not just wealth management might be able to provide better value for you over your lifetime, specifically as you move into retirement. Thank you.